Hello, and this is the second part of the video sequence on financial plans using this basic plan of the pizza parlour, which we looked at the cash flow last time. Now I'd like to just look at the profit calculation and the forecast balance sheet this time. So first of all, the profit. Now the most important thing we need to learn here is that profit is not the same as the amount of money we've got in the bank, and we can see that clearly if we look at the cash flow. You can see we end up with £108 in at the end of March, so not much money there. But we're saying here in the profit calculation that we made £3,000 profit. So we need to understand why the two are different, because they usually will be different. Okay, now the calculation for profit is simply the sales we've made in the 3 months. Notice the profit must be for a period of time, so a year, 3 months, whatever it is, the profit must be for a period of time. We must state that. So the profit here, the sales figure, that's what we've sold, so we take the sales and then we deduct all the expenses that we've had in making those sales. And the way to think of that is the expenses we've used up. So we've paid for them and used them. Sorry, not necessarily paid for them. We've just used them up. We may not have paid for them. Doesn't matter. We've used them up. We may have to pay later. So the expenses we've used up. So we've used up the food ingredients. We can see every month we've paid out 1,344. So that's £4,000 in the 3 months for ingredients. So we've used that up. We've used the ingredients, they've all gone, got to buy some more in April. So that's one of the expenses. We can do a little calculation here to get the gross profit. That's the sales minus the food cost, gives us gross profit. We could miss that out, just put this as an expense and add it to the other expenses, but we'll do that little sort of bit in the middle there. And then the other expenses that we've used up, we've used the rent, we've had the shop for 3 months at £600 a month. We've had heating and lighting at £200 each month. We've used all that heating and lighting, and we've had people working for us at £1,200 a month, so £3,600 over the 3 months. So our total expenses are £6,000. Deduct that from the £9,400 gross profit. We've made £3,408. Now notice that we have not got some things that you might think are expenses, but we're not putting them in there, especially the equipment and the fittings. Now the reason they're not in there is because we haven't used them all up. We still, hopefully, that we've still got the ovens, we've still got this counter and the fittings, they're still there in the business. So they've not been used up in the period, and also the bike, presume that's still there. So they've not been used up, so we don't include them as part of the expenses, only things that have been used up. What we could put in, we're keeping it simple on this one, but we could put in there the depreciation on the equipment and fittings. That would be an allowance for the amount of those things, those assets that we have used up. So the fittings, maybe we've worn them out a little bit, so we could put in a depreciation amount in the expenses. I've kept it simple and not put that in, but that's the way we could include it. So notice sales minus expenses. Also the capital's not in there. Capital is not a sale. It's money that's put into the business. It's not a sale. You didn't sell anybody. It was the owner's money, and it's not an expense. So it's only sales minus expenses, including the food cost. Okay, so that's one reason why the profit will always, nearly always, be different to any cash balance that you might have. Now onto the balance sheet. And this shows us our position at the end of the period that we're looking at, the end of March in this case. And we've got assets, we've got equipment, we've got fittings. Now we've still got them. We're assuming they're still worth the same as when we bought them. Of course, in reality, there'd be some depreciation, wear and tear, and also they'd be second hand now, so they wouldn't be worth quite as much. But we put them in at cost, or cost minus depreciation, because presumably we're not going to sell them and it's a continuing business. So we can put them in at that figure, or minus a little bit of depreciation. Bike's still there, goes in at its original figure, and the cash we've got is the one that we worked out in this cash flow. We worked out that we'd have £108 left at the end of March. So that's, as at the end of March, that's how much cash we've got. Cash, bank, same thing. We don't have any liabilities. We don't owe any money to, with no loans, with no bank overdraft, with no creditors. So there's no liabilities. So our net assets, we've got all our assets added up there, minus any liabilities, which there's none. So our net assets, 5,408. That shows what we've got minus what we owe. That's our net assets. And then the other side of the balance sheet, really, the other part of the balance sheet, is that we've got the capital that we put in. Now the capital, just to remind you, is what the owner has put into the business. It's a sort of liability because the business owes that to the owner, and the capital really shows the value of the business, or the balance sheet value of the business. So on day one, the value of the business was £2,000 because we put the 2,000 in and we had no other things there. But obviously once we bought all the equipment, started the business running, the business has made a profit of 3,408 after all the expenses. So now the business is worth 5,408. In theory, we could sell all the assets, cash in the money in the bank, and we'd get 5,408. And that would then be paid back to the owner. So that's now. Some of you might be saying, fair enough, that the fittings and the equipment after 3 months would be second hand, you wouldn't get as much. That's true. We always have to look at a business as though it's a going concern, i.e. it will continue, so those equipment and fittings, they're going to be useful for the business, and we need them there so we can value them at what they're worth to us, rather than the sort of trade-in value if we went bankrupt and had to sell them in a hurry. And there's your balance sheet, and there's your profit for the first 3 months. We could do the same thing for the next 3 months, work through a cash flow to get the balance at the end of the 3 months, calculate the profit for that 3 months, and do another balance sheet, and it keeps flowing. The 5,408 will be the opening capital at the beginning of the next period. It won't be the opening bank balance. The opening bank balance will be 108. Capital is not cash. So that 5,408 is not cash. It's those things added up, minus any liabilities. Because we could now, that capital has gone into buying equipment, fittings, a bike, and some money in the bank. So it's not necessarily cash, which is again a common misnomer or mistake that some people make. Okay, thanks very much. Bye.